Hello, welcome for another exciting and interesting episode of the Dealmakers Series. My name is James Sackey. Today, I'm joined by Barrett Kingsriter. He is the Senior Managing Director for Pinecrest Capital Partners. Barrett, how are you doing today, sir? You want to give us a quick introduction of yourself and the company?
Sure, doing great, James. Thanks for having us on. Pinecrest Capital is a middle market investment banking firm. We've been around for over 10 years now, serving clients in North Texas, broadly Texas region, and nationally as well for the last decade. Principally focused on sell-side M&A, but we do some buy-side, some capital raising, and some direct investing as well.
Awesome. Thank you for joining us, man. I really do appreciate it. So if you're ready, we can jump right into it. How would you describe the current state of M&A and deal flow here in DFW or Texas as a whole?
Sure. I think current state of M&A is good. It's optimistic. We've just come off of 2 years where volume has been down, kind of post-COVID, post-2021. We had a huge spike in volume in 21. 22, 23 were more depressed years. We saw a recovery in M&A volume in 24, and I think we've got good momentum going into Q1 of this year. We've seen lower interest rates, rate stability, more rate stability, increased capital on the sidelines from a private equity standpoint. So I think there's good pressure, buying pressure. There's good momentum there, and I think volume has not been exactly where the market was maybe expecting it to be so far in Q1. But I'd still expect for 2025 to be up year over year to 24.
Sure. I'm curious just to kind of follow up a little bit, as I've been getting a similar response around this first part of the year. What do you think is kind of stalling out the activity this year?
I think it's really just timing, honestly. And I do think, we've got a new administration. We've got some new question marks around some monetary policy, and that may have an impact on deal making. In the Texas market in general, there's a little more exposure to international markets like Mexico. You've got looming tariff questions. That might have be holding back the market a little bit. I think there's also a question mark in sellers' minds if we're going to see any sort of changes in tax policy and when those changes might take effect. Will they be retroactive to beginning of the year? Will they be as soon as legislation is signed? Will it be next year? And so there might just be some sellers sitting on the sidelines waiting to see how that dialogue plays out in Congress.
Yeah, that's what I'm thinking as well too. So for my next question is kind of a little broad. Where are you or your clients finding value?
Sure, I think we're finding value in a variety of areas. We tend to not reflect the market, but we follow the market and where private equity tends to be hunting. And I think when you have, as we've been dealing with for the past couple of years, questions about the economy, are we, potentially moving into a recession? Are we going to have a soft landing or a hard landing? What's the Fed going to do? As these questions have been really swirling over the last couple of years, we've seen a general shift towards safety from a focus standpoint. So what is safety when you're a private equity firm? You're typically looking more for recurring revenue type businesses that provide mission critical services or call it mission critical products to consumers. More along the staples. And so I think we've seen certain industries really start to take off as a result of that, or industries that have already been in demand maintain that same level of demand. Immediately, industries that come to mind are HVAC, plumbing, electrical type businesses, both residential and commercial, where you've got a high need for recurring maintenance and services, and where these are dollars that you're not going to skip on spending. If you're in Texas and it's in the summertime and your AC is not working, you're getting it fixed, right?
Yeah.
So really anything in the genre of commercial or residential services has been in demand. From a business services standpoint too, we've seen very high demand for outsourced IT services. There's another particular industry that's been under consolidation. Private equity loves wildly fragmented industries that have recurring revenue streams and sticky customer relationships. And anywhere where you can find that, we're finding value in those types of industries. I would say another way to look at it outside of the industries is really just process and quality. When you see deal volume come down like we have in the last couple of years, you tend to see it's the higher quality transactions that are going to transact. And so deals with more hair on them or who are not as well prepared to go to market, those are the ones that are going to get passed over for the higher quality transactions. And so we're seeing a lot of value in longer term preparation. So instead of being ready to, to sign up an investment bank and go to market, we're working with clients over longer periods of time to get them better prepared to run a process, 6 months to 2 years in advance of a process, just to make sure that they're really ready to go.
Yeah, I've definitely been hearing something similar as a lengthier due diligence process for sure, and just kind of getting prepared. I like it. So you mentioned this earlier a little bit, and I want to kind of get some more insight and kind of peel back a layer of the onion. How is the current climate with interest rates and now tariffs impacting deals?
I think 22, 23 certainly were pretty materially impacted from a deal volume standpoint by being in a rising rate environment.
Right.
And it's not just purely the rate; it's the change in rate. And so, if you know that where SOFR is and where it's likely going to be, if you have rate stability, then you just simply price it into deals. It has an impact overall on multiples and enterprise value as cost of capital goes up. But at least you have a stable environment. We didn't really have that in 22 and 23. The market was trying to find where its risk tolerance was and how high rates were going to go. We saw volume really significantly rebound, I think, second half of 24. And as a reflection, I think, of a lot more rate stability. And so you've got the psychology, of course, of buyers and sellers and where valuations should be relative to where they have been. When debt is really, really cheap, it's a lot easier to put some more debt on a transaction and price that in, and sellers get accustomed to a little higher multiples. As that rate starts to increase, it's got to come out of valuations. It has to come out somewhere. And so now that we're in a more stable rate environment, I think that's had a positive impact on volume. And I think buyer and seller psychology are a lot more in line now from a valuation standpoint. The next element there tied to rate is also leverage. And so when you're in a more rate stable environment, I think banks tend to feel a little more comfortable with slightly more aggressive leverage on transactions than they were in a changing rate environment. So I think that's had a positive impact as well.
For sure. And what about on the tariff side? Any kind of insider commentary there? Has that been creeping into some of the discussions at all, or not really?
Yeah, it has. I mean, it really depends on the industry. If there's a lot of industries that obviously can be directly influenced by tariffs, and then you have to factor in what's the indirect influence from tariffs. And so if you're we have a client, for example, that has manufacturing in the U.S. and in Mexico. And if we're going to see a 25% tariff on goods imported across the border that are manufactured in Mexico, then our cost structure changes materially, and that just creates uncertainty. And buyers in general, private equity or otherwise, do not like uncertainty. And so that's any companies that have real direct cost issues or anything that will be really directly immediately impacted by tariffs, I think those transactions are going to sit on the sidelines. But then you still have to go through a diligence process on what are the indirect impacts of tariffs, and is it going to really have an effect on your industry or not.
Yeah, no, for sure. And we'll see how things unfold. I think at the time of this, we're waiting to see if some tariffs are going to actually unfold this week. So let's shift gears a little bit toward the capital stack that you're seeing. How does private credit stack up against private equity here lately?
Sure. I mean, I think in both we've seen growth in capital overhang, capital that's been raised and is still ready to be put to work. I think private credit has grown quite a bit. The market opportunity for credit has certainly strengthened. It's a good opportunity to find yield in a lower rate environment. And so, I think I would expect it to very much continue to grow, opportunities in private credit. And I think, some of the forecasts I've seen where it's going to end up at the end of this decade are pretty eye-popping. But I think that we have passed the $1 trillion mark for private credit sitting on the sidelines and being ready to put to work. And that's a pretty significant change over the last few years. So it's been really growing, and capturing a lot of attention as a strong alternative asset class.
Yeah, for sure, for sure. Okay, last question, or maybe last question. We'll see here. What makes DFW unique, or the Texas market unique against all of the others?
Yeah, it's been such a great market for so long, and it's funny, if you've been in the Texas deal community for a long time, it's not a surprise. We've seen this coming for a decade plus. In certainly in the DFW market, and in Texas in general. You've got an abundance of Fortune 500 companies, a lot of those who have relocated in the last decade. I think there's 20 or now slightly over 20 companies, Fortune 500, that are headquartered in Dallas. DFW is just a great economy, and we've been attracting high levels of population growth for the last several years running. I think we hit maybe 6% across the state of Texas in 2024, which is pretty phenomenal population growth. But even with that, given the space that we have, cost of living is still very appropriate. Housing, we have housing availability. We've got good higher education opportunities in this market. So we've got a ready, willing workforce that's a well-educated workforce with appropriate wages on a national level. And so it's a great part of the country to do business in. Very business-friendly tax environment, and so I think we'll continue to attract business. And as you see Fortune 500 companies and whatnot move in, all of the the middle market companies that tend to service growth in population and growth in larger businesses as well, those also tend to boom. And so I think everybody has noticed the growth in Texas over the last few years. A number of new private equity firms have sprung up in DFW and in Texas at large, and we're seeing just a lot of interest in investing in Texas-based businesses. And so I think that momentum is likely to continue. We need to maintain a pro-business political environment, and need to maintain good housing availability and appropriate wages, and I think we'll continue to see that growth.
Yeah, for sure. I'm thinking the same. Barrett, thank you so much for your time, your insights. I appreciate it. For all those that are watching, hopefully this is useful for you. If you'd like to see more interviews and some of the insights, you can check out my website, jamessaki.marketing, and find the other interviews from the Dealmakers series exclusively on my YouTube channel. Thank you for tuning in.
Thanks, James.